Hello there, and thanks for joining us today. Very excited to have an expert and a great presenter, Macan Nia, who you might have known before. We've done a few with these with Macan. They always come very well recommended and usually have some great takeaways. And Macan does a great job in putting things into perspective. So very excited to have Macan back with us today to give us a lowdown on all things economy, metrics, inflation, interest rates, all that fun stuff. So we're just going to let everybody settle in here. Hopefully you've got a nice lunch or whatever you're nibbling on, and we can feed your brain as well as we're getting through this. So I just want to give a big intro as we let everybody settle in. Myself, Eric, and we have Per from our team, as well as Jeff from the WWH Financial Group, and very excited to host you all today. So thank you for taking the time. And a few notes of housekeeping. We want to make this an interactive presentation. So if you do have questions, please feel free to use the chat below and we'll be happy to get to them and share that with Macan. So if things come up during the presentation, please share your thoughts. If you have thoughts that bubble up now, post them and we'll do our best to get to as many as we can today. So we'll try to get to that fairly shortly. And in terms of the agenda, we'd like to do a 30-minute and 25 minutes in presentation and then leave more time for Q&A. But like I said, we'll keep it. We'll keep the questions flowing throughout. So without further ado, I would now like to pass it on to Macan, and we're very excited to get this rolling today. Macan and the Manulife team do a great job in putting together some great visuals and slides and stories about where we are, where we're going, and it really helps put all of this together. So that's the goal for today. And without further ado, I will pass the baton off to Macan, and we'll get started.
Thanks, Eric, for that. That picture just made me realize how much older I've got over the last 10 years, but I guess that happens when you get age and you have kids specifically. So tell me when you see the screen.
Yeah, you're good.
So thank you, everyone, for joining us and taking time out of your day. Really, the idea for this is take the next 20-25 minutes to get an idea of the environment that we see that we're currently in. And then at the end, I'm going to share a couple of slides. And I think these are much more important. And I've shared them before. But in terms of, okay, how should we view investing over the long term? And that's going to be much more important. But we'll talk to the near term as well. So it's always interesting. And when it comes to markets on any given year, it seems to be particularly interesting over the past couple of years because of obviously COVID and really the hangover effects of the stimulus and all of that. Now, when it comes to the global economy, we have seen this narrative as investors, whether we're going to experience no recession, whether we're going to experience a recession. If we experience a recession, what type of recession is it going to be? Is it going to be severe? Is it going to be mild? And really that has changed throughout the year. At the beginning, most thought that we were going to get a mild recession, probably experienced by the summertime. And that has changed over the last couple of months. The data in June and July was a little bit better than expected. And all of a sudden, investors were saying no recession. We spent a lot of time in August, and we just think that narrative, there's a disconnect between the reality on the ground and perhaps sentiment of there not being a recession. There's many ways of looking at the health of the global economy. One way I'm showing you is PMIs. What are these? It's a gauge of manufacturing in each one of those countries on the left-hand side. They ask some questions related to the health of their business. I'm not going to go into the details and the math because frankly, it doesn't matter. What matters is the aggregate. Green is good, yellow is neutral, red is bad. Far left-hand side is August of 2 years ago. Far right-hand side is just this last month. A lot of yellows, lots of reds, some greens, but when there's a vast majority of yellows and reds and leading or future indicators not pointing to a material recovery, we haven't changed our view of a recession. We still think it's going to happen. It's just so happened that it's been delayed in our view. Now, there's typical signs of a recession, right? When you look at indicators, so jobs, how many houses we're creating, how easy is it to get money, things of that nature. You can lump them or you can put them into three different buckets: lagging, coincidental, leading. And as the name suggests, lagging, These things flash red after the recession. So yes, we all pay very close attention to jobs, but when jobs are in the gutter, the recession's already in its place. So we focus on the far left-hand side, and these are those leading indicators. So as the name suggests, as they flash red and yellow, it typically leads a recession. And when we're looking at most of them today, they're either yellow or red. And again, taking a holistic approach, it's like, okay, when these are yellow and red, have we avoided a recession? We don't think so. We think that all that has happened, it's just been delayed. Now, why has it been delayed? It's us, the consumer. When in developed markets like Canada, US, Europe, consumption or us spending makes up the basically 2/3 of our economic output. So we matter. And what has happened? We're looking at savings rates here in the US. The same dynamic plays in Canada going back to 1950. You can see savings rates on average is roughly 7%. You saw it spike up during COVID. Why? Government programs, money in our pockets. The vast majority of us kept our jobs. And then last but not least, we are stuck in our home, right? We couldn't go outside of spending e-commerce. We really couldn't spend money. So you saw savings rates spike up to 25%, rates we've never seen. And over the past couple of years, you have seen this come down. Higher cost of living, higher interest rate costs. We've had to use our savings rates to really cushion. The government government's forecast was that there's $2 trillion of savings accumulated during COVID. Estimates are that that's going to be running out over the next month. Now, what else have we also been using? Our plastic, our credit card. So this looks at Canadian credit card debt levels. We're at levels multi-year highs. This same dynamic plays in the US at multi-decade highs where you see credit card balances at levels we haven't seen in decades. So the question that we ask ourselves is, okay, still, yes, interest rates are coming down. Yes, inflation is coming down, but the cost of living is still high relative to history. Interest rates, although they're likely to come down, are going to be higher than what they were. Where are we going to have that buffer? If we don't have our savings, if we don't have the balances on our credit cards, where does that leave the consumer? And that's why we think the recession, and let me rephrase too, is we're going to get a recession, is probably going to be mild. I think that's an important case, but the recession's been delayed. It hasn't been avoided. So our first investment theme is prepare for near-term equity volatility amidst uncertainty. And why we think that? I want to start off and say that despite we thinking there's going to be weakness in the short term, we're still very optimistic on stocks in the medium to long term. But we think in the short term, markets are a little vulnerable. They've been priced for perfection. You may ask, what does price for perfection means? It means in the month of August, the markets were expecting, we're saying, okay, we're not going to get a recession. So the markets rallied, the S&P, for example, rallied 9% in June, July on that factor that we might not get a recession. Also, interest rate cuts. In August, we were pricing in 6 interest rate cuts. Why is that important? Because we as investors love interest rate cuts. Why? Well, if we cut interest rates, it's stimulative for the broader economy, stimulus for profits. Now, the challenge is we didn't think at that time we would get 6 cuts. It's probably be less. So any changes to those narratives creates near-term volatility. And you've already seen that. Towards the end of August, inflation data was above what market investors were expecting. So instead of those 6 interest rate cuts, it came all the way down to, I think last time I checked was 3.5. And that's created volatility. And as the data comes out suggesting that we may not have avoided a recession, in the near term, we think there's volatility to the downside. Now, one thing I want to highlight here is AI, because we get lots of questions on artificial intelligence, its impact on the markets moving forward. And one thing to highlight first is, and this was a couple of weeks ago, the same dynamic plays here, is what you're looking at here is the return of the S&P 500 throughout 2023. And that's highlighted by that salmon line or red line, whatever it is, at 16%. What that green line is showing, how much of that return was being driven by the top 10 biggest names in the S&P 500. So the S&P 500 is the 500 largest corporations in the US, and the green line is just the top 10 of them. So the top 10, dominated by technology, has driven a lot of the performance for the S&P 500 this year. Now, our view on it is a couple. One is we get to question the impact of artificial intelligence on markets, on profits. And there's no doubt that we're going to be getting benefits of artificial intelligence. But what I wonder is how much of that is maybe too optimistic. And what I mean by that, we have measures in markets where it's how much you're paying for $1 of profits. It's called PE. So basically, if it's 15 times, what that means is I'm paying $15 for every $1 of profit. Now, just like anything in life, the cheaper you buy it, the more likely you're going to be happy. What has happened with tech is because we've seen a rally, you are paying $10 more per day or per unit of profit than what you were doing at the beginning of the year. That's a very, very big premium to be paying. So our view is we like tech, but I think we still need to own tech in the right amount. So if you own tech, it's gone overweight, then maybe it's not a bad idea to sell some of those profits and recycle to the rest of the economy or rest of the market that hasn't rallied. And even too, when it comes to AI, it's very hard to, when it comes to technology, it's very hard to pinpoint who's going to be the winners and losers, right? We know with technology, often the first movers are very rarely the ones that benefit over the long run. Look no further than your phone. How many of us have obviously, how many of us have a phone? All of us have a phone. We have iPhones and we have maybe Samsungs. What was the original phone? Think back to .com. You might say BlackBerry. Some of us might say Motorola. But it was actually Palm Pilot. Remember the Palm Pilot? It was the first phone. No one remembers that today. So when it comes to tech, what I've experienced is it's very rarely the first movers that benefit. And as a result, am I willing to pay 10 times more for that one level of profit? I think you have to be a little bit cautious. Now, when it comes to, we're talking about a slowdown in the US economy, Canadian economy, increased odds of a recession. Someone in a call might say, oh my goodness, should I be selling my stocks? Absolutely not. Now is the time to potentially, depending on your risk profile and what you own, if you're already not slightly defensive or have, I shouldn't say defensive, high quality companies, maybe now's the time to be adding them. And I know I've worked over the years very closely with the team here. And the way I know they fit the same criteria as what I'm investing, what I'm speaking to now, but quality is important in this type of environment. Businesses that have strong balance sheets, that sell a product that is very hard to switch from, that you want, regardless of the environment, will most likely benefit. Look at this example. So we've talked a lot about inflation over the past couple of years. And what I did here is I broke it down into, okay, we mentioned the S&P 500 largest companies. The green line here is of those 500, which one of those companies have paid a dividend and have grown their dividend over the last 5 years. Or sorry, last 5 years, last 50 years. Quality business. If you're going to pay money out and you've been paying it for 50 years, you have a strong balance sheet. That's the green line. The blue line is the broader index, like I mentioned, the 500 companies. What I find interesting is whether inflation is increasing or decreasing, these companies that have strong positions outperform the broader market. And in an environment that, let's say we're going to get a slowdown, you want to have exposure to these type of companies. And working with Per, Erik, and Jeff over the last many, many years, I know these are the solutions that they've been getting from us in terms of putting into your portfolio. And these companies, yes, the prices will fall, right? If you get a recession, no one is immune. What I care about, what you should care about is, has the underlying business gone away? Because if it has not, and it has not been impacted, markets always recover. Those companies will recover as a result. And look no further than COVID, great financial crisis, any sell-off, all stocks come down. But those companies that their business models haven't been impacted, they recover and then continue to grow. Now let's switch to our second theme, the bond themes. Like a lot of questions on interest rates. We're going to talk about it, inflation, and it's important to invest in the right bonds. Now, why do we own bonds? I know it sounds like a silly question, but I think some investors have kind of forgot, given the nightmare of the return profile over the last few years in bonds. Well, you own bonds for two reasons: income, downside protection when stocks fall. And that has historically been the two reasons. When you look at that first component, income, that's what we're looking at here. We're looking at various bonds across the world. So you have US government bonds. What's US credit, Canadian credit? Credit, all it is corporate bonds. So Apple has a stock, they also have a bond. So those high quality bonds are these US credit, Canadian credit, and then other bond indices. Look what the yields you're getting. So I'm going to highlight Canada credit on the far right. You are getting paid close to 5.5% in income just by owning high quality Canadian corporate bonds. So from an income perspective, I would argue that it's never been more attractive over the last couple of decades when it comes from an income perspective. Now, the second part of bonds is not only you're getting your income, you have the potential for price appreciation or price depreciation. Now, we've experienced the price depreciation over the past few years. Why? The dynamic just works. This is how the math is. As interest rates go up, bond prices come down. And historically, before COVID, as stocks sold off, why do stocks sell off? Right? Stocks sell off because we are worried about the economic environment. That's why stocks sell off. What do central banks do when the economy weakens? They cut interest rates. So as they cut interest rates, those bond prices go up. So as stocks have been falling historically, central banks will be cutting interest rates. So the bonds have been going up while your stocks have been going down, acting as the counterbalance. COVID happened, a once in a generational type event, and that dynamic went out the window for a few years. Why? Because inflation was going up. Despite the economy just whatever, inflation was going up. Central banks had to raise interest rates, and you saw your bond prices go down. To where we are today, roughly, and I'm looking at US high quality bonds here. Bonds, you look at the far right, are trading at $88. What's important about that number? Bonds mature, they basically come in at 100. So you have potentially from 88 to 100 of price appreciation. What has to happen? Interest rates have to fall to get that. And in our view, as the economy continues to slow, central banks, so ask yourself, do you think central banks are going to, Canada goes through a period of slowness or recession? Is the Bank of Canada going to keep raising rates or decreasing rates? They'll decrease rates. So as they decrease rates, those bond prices have the ability to move up with your yield. And that's why we think it's very, not dangerous, but in investing, don't look at the rearview mirror and expect those returns moving forward. You have to look forward. So I think those bond investors looking at the last year of performance and extrapolating that forward, it comes at the risk of their own bond portfolios. There was one other thing. Oh, interest rates. So when it comes to interest rates, okay, we've been lots of questions. What's going to happen? I think that central banks are much more closer to the point of pausing what they've hiked. So we've seen aggressive hikes since the summer of last year to really cool down the economy. It's cooling it down. So I think, will they raise maybe one or two times? Maybe the Bank of Canada slips another one in, but we are much closer to the end. If we're using percentages, 90%. I know it's we're in a full swing of baseball, but hopefully October baseball for the Jays. We're probably in the 8th inning of the tightening cycle. So much closer to the end, and then they will be cutting. So the benefits of bonds have not changed. If anything, they've probably got better over the past few years. And then I'm going to transition to this point, because what we've talked about is, okay, our view is in the short term, we think global economies continue to slow. It will create downside risk for equity markets. We've already seen that so far. After being up 8%, I think it was up 9% June and July, August, September, I think we're down 7-8%. It's likely to continue, but I want you to remember that this is only in the short term. If you're in those high quality businesses, if you're hitting those headlines, you have two hands. If you have that one hand want to call basically either pair Eric or Jeff and say, listen, I want to sell out of my stocks, sit on that hand. Don't let that hand sell. But if you have that hand that wants to buy, let that hand buy. It's during these periods of weakness that really sets you up for the medium to long term. And I always say, if you feel sick to your stomach by sending an email to pair Jeff and Erik in terms of buying, it's probably a good time to buy. Whenever Warren Buffett says, when others are fearful, I get greedy. When others are greedy, I get fearful. So remember that. So let's transition to the next couple slides, because I think these are the slides that I want you to take away for the rest of your investing time horizon, because these few matter. I'm going to skip these two, start with this. So how many of you, if I was in front of you, I'd tongue-in-cheek sit down with you and say, how many are you invested in the equity markets because you love the day-to-day volatility? You laugh, no one puts up their hands. Why do you invest in the stock market? Is because when you sat down with Per, Erik, and Jeff, you said, okay, these are my hopes, dreams, and wishes for a point in the future. This is how much money I have today. It's not enough. I need it to grow. And the equity markets have provided that over the long run. That's what we're looking at here. The green vertical lines are the return for the S&P 500 going back to 1980 per year. What sticks out to you? What sticks out to me is that the majority of time, these green lines are positive. In fact, 80% of the time, they're positive. And the average return, depends on when you invest, is between 8 and 12%. What are those blue dots? Those blue dots are the biggest sell in any one of those years. So let's look at 2020 here on the far right. So what this is saying, if you invested $1 on Jan 1st, went into a cave, reappeared on December 31st, that $1 was up 16%. Despite being down 34% at its lows, which was in the March of that year, the depth of the sell-off in March. So when I look at this, I see that the majority of time markets are up, highlighted by those green lines, but the ride is never smooth, indicated by those blue dots. So in fact, we get 2 5% sell-offs in any given year. We get 1 10% correction every couple of years, and we get a bear market. What's a bear market? A sell-off of greater than 20% every 4 years or so. So sell-offs are common. They happen. We have to ignore them. Ignore wanting to sell into them. Take advantage of them by buying into them. So I want you to remember, next time we get a sell-off, we get those headline risks. Remember, if I'm going to reach my hopes, dreams, and wishes, I have to earn those green lines, which means I have to ignore those blue dots, which are more often than not headline negative news. And then I'm going to finish with this one. The reality is as investors, you are not paid to be a pessimist. You want to be a Leaf fan, be a pessimist, then by all means go ahead, because it's probably better for your sanity. But when it comes to markets, you are paid to be an optimist. I learned this myself early in my career. Early in my career was during the depths of the great financial crisis. So not that we want to relive what happened, but let's quickly reflect what was happening at that period. The S&P 500 fell 56%. It kind of makes the 36% fall during COVID. Think about that. During COVID, we shut down the global economy. We literally shut down the global economy. We have never done that before. And markets fell 36%. The great financial crisis, they fell 56%. It just shows you the depths of the great financial crisis. We didn't know. We would be walking into the office every morning. I remember the S&P 500, the broad US stock market, was down 5% a day. We've never seen stuff like that. Major US institutions were going bankrupt. We didn't know who was going to survive. Well, that had an impact on me coming out. I was young in my career, and I was like, what have I got myself into? But B, I came out with more of a negative lens. And I learned very quickly, I'm not paid to be a pessimist. I'm paid to be an optimist. The data suggests. What we're looking at here is essentially in these time frames, over the last 50 years, the odds of being either negative or positive. So daily. So on any given day, the market, the odds of being positive or negative is basically 51% to 49%. I always joke that my 3 and 7-year-old girls have as equal of a chance of predicting tomorrow's move in the market as I do. But when you sat down with Per, Jeff, or Erik, were you talking about your hopes, dreams, and wishes tomorrow or the next month or the next year. No, your time frame was much longer. Well, what happens, and I always start this part before I say this point, is I wish I had a crystal ball. I'm sure we all wish we had crystal balls. We don't. Investing by nature is a probability-based decision. It's statistics. You want to invest when the odds are in your favor, not invest when the odds are against. When your time horizon is greater than 3 years, 5 years, what are the odds? Close to high 80%, 90% odds of being in your favor. If you take those odds at anything else in your life, would you shy away from it or would you embrace it? You would embrace it 90% of the time over. And think about that over the last 50 years, because we always hear this time is different. During great financial crisis, this time is different. During COVID, this time is different. Think about the last 50 years and everything that has happened. And this is saying in any 5-year rolling period, the odds of being positive in any over the last 50 years is 90%. So I want you to remember this, because as investors, we have a tendency of reacting to short-term news and foregoing our long-term plans. You sat down, you created this long-term plan. Then don't get caught up in the short term and react, because we know those investors that do, they get impacted negatively. So the average return for the broad US market is 8 to 9%. The average return for an end client is 3 or 4%. I think it's 3%. Why? Is because when there's euphoria, they're buying, and then the negativity sets in, they lose money. And when no one wants, like basically, when it's time not to sell, you're selling. When everything looks terrible, you want to sell, you shouldn't be selling. There's an interesting study, I forget who did it. I think it's MBER. I can't think of it now. But end clients that have an advisor, their return is basically double than if they did not. Why? Is because you might get, caught up. We're emotional beings. And then it's basically Erik and Jeff's job to walk you back from the cliff. And the data suggests, again, we're emotional beings, especially when it comes to money, we become more emotional. The importance of having a long-term time frame and keeping to it and not getting impacted by the short-term noise. And I'll leave with this point. Look at last year. September, we were down, I think we were down close to, let's just say 9-10%. October, we were up 8%. We basically got it all back up. But if you reacted in September, from basically November to June, markets were up 15%. So if you reacted negatively in September because of the sell-off, you would have foregone getting it all back in October, and then the extra 15% that you got on top of it. So I'll end off with this quote because I think it's important, is when I look at investing, it's important to be invested in high quality businesses, of course. But investing is also like soap. The more you touch it, the smaller it gets. And we find that clients that are trying to get in, get out, get in, cut it out, it goes against the returns over the long run. Those buy and hold type of investors are the ones that benefit over the long run. So I'll stop there. I'll pass it back over to the two of you. And if there's any questions, I'll be more than happy to try to address them.
Well, thanks, Macan. That was really great. So I have a couple of questions, and I'm sure Erik and Jeff and the people on the call do as well. But the first one I'm going to ask you is, if you go back to that slide that you showed where you were showing the components of the S&P 500 return, and you were showing, where it came from, and a lot of it came from tech, right? So it was a soft question for you because we all know the answer, but why should I stay diversified? Why shouldn't I just have gone and bought all Tesla or the big 6 tech companies or all Nvidia, as opposed to staying diversified? What's the benefit of doing that when we know that most of the returns coming from those?
Well, that's for this year. Now, if you break it down into previous years, it'll be a drastically different environment. So the importance of diversification for me anyways is I have my views of the markets. I'm very mindful of the fact that I'm going to be wrong at best 30% of the time, right? But the key is when you're wrong, that they're not big wrongs. Like you haven't made a really outsized bet. So that's why you diversify, is you limit that 30% chance of being wrong or having an impact on the broader portfolio. And in any given year, economies are like living organisms, right? So this year, artificial intelligence is driving it. You know what's going to probably happen next year is as we go through a recession and recover, we're going to get that next step up where those, and we call them cyclical. So those type of this parts of the market that are leveraged to growth will do well. Then we'll go through a period where we're slowed down, where you want to have maybe more defensive, but generally diversification is important because there's always an opportunity somewhere, and you want to make sure that you don't have one's outsized. If you have children, you're not going to tell your child to just focus on one thing. You want them to have a backup plan as well, right? You want to diversify because not everything always works the way you anticipate it. So that's the biggest thing of diversification. It smooths out the return profile.
Macan, can you hear me?
Yeah, I can hear you, Jeff.
Great presentation. I applaud you for having the courage to tell it like it is when in so many other commentaries that we hear either on TV or not, they're trying to either make the case for well, there may be a soft landing, there may not. I don't think I mean, it's important to understand the context of it, but we don't invest to beat the market. We invest to participate in the profits of good companies, right? And ultimately, good companies are going to be profitable, and we're gonna see our share prices or our dividends for that profitability. So, not so worried, but I am. First of all, there's one slide I do love, and that's your percentage, your probability slide of where you show percentages for being invested over longer terms, which I really think helps us visualize, the rationale for why we own equities. But I'm curious to know if in the portfolios that we work with, the dividend funds, the growth and income, etc., have they adjusted their assets? Because that's part of the reason that we invest with managers, is that we allow them to make small adjustments in the interim on our behalf. Have they adjusted in any way, shape, or form to this model that you're projecting?
Yeah, so I think generally, Jeff, is the solutions that you work with us generally are very high quality in terms of the businesses that we manage. So a good example is, not that I'm saying go out and buy the stock, but like a company like Waste Connections, right? So what does Waste Connections do? They pick, like, my garbage day was this morning. So regardless of whether we're in a recession or not in a recession, or inflation at 10% or at 2%, I'm putting my garbage in.
Mm-hmm.
And the city of Toronto has a couple potential options to utilize as their garbage collector. So it's a high quality business, because for the city of Toronto to switch their service, it's not that easy. It's not like buying whatever you're buying. It's a big thing. So they know that. Waste Connections knows that. And they know that every year they can increase how much they charge the city of Toronto by 2 to 3%. And it goes to their bottom line. And the city of Toronto is not going to argue, because they have to take it. So our managers have been generally buy these types of businesses. I ask them now, are you finding opportunities? They are finding opportunities, because the rest of the market hasn't really participated, and they're finding opportunities. And that's the importance of active management too, is not all companies in this environment of higher inflation, higher interest rates are going to be treated the same. Look at your own personal group of friends, family friends. Some are more vulnerable to higher interest rates than others, given their debt levels. The same applies to corporations. So there's always opportunities to make money. You just need a good active manager to find those. So yeah, they are finding opportunities underneath the hood, definitely. But they actually find more opportunities when markets sell off. When markets sell off, it's everything gets sold off together. It's a voting machine. It's not reality. And then that's when our managers come in and say, okay, well, why? I'm not saying Roger, but why was Rogers off 20%? Let's just say, does it make sense? Has it created an opportunity? Where does it disconnect? And that's where our managers really shine, is actually the real way to make money is during these times of volatility.
And the other point I should make to all those who are on the call, we're into September, we're 3/4 of the way through the year. Most of us, we've seen returns up to this point of about 9% 7, 8, 9%. Even bonds, which are at 5 3/4, haven't seen those kind of returns, and certainly not tax advantaged returns. And if we're drawing any income from our investments, well, we've drawn it off of a very positive year so far. So even if, you know, in the last 3 months there's a correction, you know, from the money that we've pulled out, if we're drawing income, has been from the positive returns of the portfolios rather than from a negative return so far this year, which is, you know, which I think people tend to overlook. So, but very good, very interesting.
Macan, wanted to ask, I mean, I presume that you've spoken to a few of the asset allocation teams at Manulife. Are you able to share kind of what they're hearing and maybe on the managed portfolio side, how portfolio managers are thinking about asset allocation with regards to equity, fixed income, and cash? Anything to share on that side of things, given where we are with the current environment?
Yeah, I think the bigger one here is the bond component of a balanced portfolio, right? Like if you have a balanced portfolio, you have some stocks, you have some bonds. And the past year, couple years have been very painful for bond investors, no doubt. We've all felt the pain. And I actually think it's a positive thing, and hear me out, is I think before this, interest rates were basically zero. They're slowly going up. But this reset, now you can get high quality. Like, think about pre-COVID. Think about you guys in terms of what you're putting into your financial plans for the clients on the call in terms of your bond return expectations. Pre-COVID, it was maybe 2, maybe 3%. Today, we can put 5.5, let's just say, being conservative, 5 to 6% over the next couple of years from just our bonds. And the reality is, I think the odds of our end clients meeting their financial goals has actually improved. Despite the last year, I actually think they've improved moving forward, because now we can get 5% out of bonds instead of getting 2%. And that is supposed to be the safe part of our portfolio. And then add on top of that the equity. So that general theme is being shared by our equity and bond managers, is the opportunity in bonds today. It's been a bit delayed, right? In terms of, we haven't seen interest rates fall yet, but if it unfolds the way we think it's going to unfold, I think you're going to be very happy with your bond returns moving forward. And that's just the general consensus across our PMs.
Well said. So I think we'll pause there. I'll have a look to see if there are any questions. I mean, we did a nice tour of the state of things, so I always enjoy getting your take on things, Macan, and how you present information. I mean, there is a lot there, but you do really have a nice way of bringing that to life and kind of helping us tease out what you're hearing and sharing that in terms of what it means for investments and moving forward. One last prediction for you: are the Jays going to make the playoffs, and does it really matter if they can't get on base?
I think they're going to make the playoffs. I just don't know how far they're going to go. But no, look, maybe this is the optimist in me, but look at Philadelphia last year. They're the last wildcard team, and you just get hot for a couple weeks, and that's all that matters. And they won the World Series. So maybe it's the eternal optimist in me thinking that they'll get in, and then they got to get on base. And they got to start getting people in when they get on base. But
you know, you're showing your blue and white colors right now.
Yeah, I am. I'm definitely sharing. If they can just get, spit a fresh. Last comment is, it's the only year as a Jays fan where they could have someone on first and third with nobody out, and I actually don't know if they're going to score. I don't think I've ever experienced that as a Jays fan. So it has been a very unique year for the Jays as well.
Well, we hope
it's been a good year for Canadian teams. So, if the men's basketball team can qualify for the Olympics, and last night the women's national team for soccer not qualified for the Olympics, hopefully the Jays can qualify for the playoffs. So fingers crossed, right?
Yeah, and we won't have to wake up at 5 a.m. to watch the Jays like we had to with men's. Some rough nights rough days after waking up at 4 or 5 in the morning. That's for sure.
Yeah, this summer was early or middle of the night watching the Women's World Cup for sure.
Yeah,
but
definitely.
Fingers crossed. And then next year the Olympics are in France, so that'll be much more digestible.
Yes, absolutely.
They go to bed before us, so it's good.
Yeah.
Good. Well, thank you, Macan. Thanks,
you, Per.
Eric. Thank you to Leah for organizing all of this, putting it all together as usual. Hopefully people enjoy it. If you do have questions afterwards, feel free to reach out by email to Eric, Jeff, or myself. Feel free to share this recording with your friends and people you don't like as well. And with that, I think we wish everybody a great day. I'll leave it to Eric and Jeff to sign off.
Yep, sounds good. Nice to see a few of some familiar names in the audience today. So thank you for attending, and looking forward to the next one.
Take care, everyone.
Thanks again, everybody.
Have a great day.